You know that feeling when a brown envelope lands on the mat and you leave it there for a day or two, not because you are lazy, but because you already know it will bring hassle and you are tired of hassle. Or you open your bank app, see a number that looks a bit lower than it ought to, and cannot quite tell what has eaten the difference. That is how tax trouble usually starts in later life, not with a bang, but with a quiet little leak. And if you like the way we talk things through here, in a calm and sensible way, do subscribe to the channel. It helps this little corner of YouTube reach more ordinary British people who simply want straight answers without the noise. Because today we are talking about 3 quiet tax mistakes pensioners make before April, and the reason they matter is simple. By the time you notice the leak, the money has often been gone for months. The theme holding this whole conversation together is this: small checks in March prevent silent losses in April. I want to walk you through 6 things today because the 3 big mistakes usually hide inside 6 very ordinary moments. First comes the wrong tax code, then the way different incomes stack together, then the trap of one-off withdrawals. After that, we need to look at savings interest, household allowances, and the paperwork that tells you trouble is brewing. The first quiet mistake usually begins with something boring, which is exactly why people miss it. You get a letter about your tax code, or you see a line on a pension payslip, and it looks too dry to bother with. Most people assume the code must be right because it came from the system, and the system surely knows what it is doing. That assumption costs a lot of pensioners money every single year. A tax code is simply the instruction telling a pension provider how much tax to take from that income. If the code is wrong, the provider can still be doing its job perfectly, but the result in your pocket is still wrong. This happens a lot when you have a state pension, a private pension, maybe a small workplace pension, and perhaps a bit of casual work. The system tries to knit those pieces together, and sometimes it knits them badly. One thing many people do not realize is that the state pension is taxable income, but tax is not usually taken off it before you receive it. That means HMRC often collects the tax due on your state pension by adjusting the code on another pension or job. If the figures they use are old, or one pension has changed, or one income has stopped, the code can drift badly out of line. That is why the phrase to write down is this: never trust the code, check the code. If this sort of plain English checkup is useful to you, subscribe and keep me in your corner. I do not want you learning these things from a nasty surprise in May when the tax year has already turned. Your simple job before April is to compare the code on each pension payslip with what you are actually receiving now. Quiet leaks stay quiet only because nobody lifts the lid and looks. Let me give you a real sort of story because this is where it becomes painfully familiar. Graham is 68, retired from the railways, and he has his state pension plus 2 modest private pensions. One of the private pensions was reduced after he took a small lump sum for repairs, but the tax code on the other one never caught up. He kept saying to himself that HMRC would sort it out eventually, because that is what we all hope. By the end of the year, Graham had been paying too much tax every month and had not noticed because each month it was only a bit, not a catastrophe, just enough to make the food shop feel tighter and the car insurance sting more than it should. When he finally checked, the refund was welcome. But the better truth was this: that money should have stayed in his account all along. That is the first principle of this video. Money lost quietly still matters just as much as money lost loudly. The second quiet mistake is not about the code itself, but about how people think about their income. A lot of pensioners look at each payment separately and say, well, that pension is small, that savings account is small, that part-time wage is small. Tax does not think that way. Tax adds things together. And that is where the surprise begins. Your personal allowance is the amount you can usually receive before income tax starts, but it applies to your total taxable income, not each bit on its own. So your state pension, private pensions, earnings from a few shifts, rental income, and in some cases savings income can all push against the same limit. A small amount from 3 or 4 places can suddenly become one not so small total. The mistake is not greed or carelessness. It is simply forgetting that the system counts in totals. That is why the phrase worth remembering here is this: total income beats each income. If you say that to yourself before April, you will start looking at the whole picture instead of one envelope at a time. Many people only discover the problem when a provider takes too little tax and then HMRC asks for the balance later. And if you would like more of these quiet warnings before they become expensive lessons, do consider subscribing. This especially catches people in the year they retire, the year they start a second pension, or the year they do a bit of work on the side. You might think, I only helped my old employer for a few weeks, or I only drew a little from that old pot, so it cannot matter much. But when those pieces land in the same tax year, they can change the tax due on everything else around them. The big idea is simple. A modest life can still produce a complicated tax picture. I have spoken to many people who say the same thing in different words. They tell me they felt they had done nothing unusual, and that is exactly why the bill felt unfair. But tax trouble in retirement often comes from normal life, not reckless life. One extra payment, one old pension waking up, one bit of bank interest, and suddenly April looks different. The third quiet mistake is one of the nastiest because it feels so reasonable at the time. You need money for a boiler, a car, helping family, or just breathing room, so you take a one-off withdrawal from a pension pot. You expect tax to be taken, of course, but you do not expect the amount to look absurd. Then the payment arrives, and far too much has gone. This usually happens because the first flexible withdrawal can be taxed on an emergency basis. That means the system may act as though you will keep taking that same amount every month for the rest of the year. So a one-off withdrawal is treated like the first slice of a much larger annual income. It is not always the final tax you owe, but it can be a nasty hit to your cash flow. The phrase to remember here is this: do not yank, stage it. Sometimes taking money in smaller planned steps or understanding the reclaim process first can save a great deal of stress. And if you ever watch one of these videos and think, I wish somebody had told my brother this last year, that is exactly why this channel exists, so feel free to subscribe. A calm warning given early is worth more than a clever explanation given late. Take Sheila, who is 72 and widowed, living carefully but sensibly on her pension and a small nest egg. Her freezer failed, then the washing machine went, and her daughter said, just pull some money from that pension pot and get it sorted. Perfectly normal advice, and she did exactly that. What she was not prepared for was the emergency tax that made the payment far smaller than she expected. Sheila felt embarrassed, then cross, then worried that she had done something wrong. In fact, she had not done anything wrong at all, but nobody had explained the rule in plain English before she touched the money. Later, she reclaimed what she was due, but the month itself was harder than it needed to be. That is the third quiet lesson. Even when tax comes back later, the strain it causes in the meantime is still real. Now the fourth thing to watch before April sits a bit more quietly in the background. It is savings interest, because after years of low rates, many older savers are earning enough interest again for tax to matter. You see a few interest payments come in and they feel like a small bonus, which is fair enough. But for some people, they also change the tax picture. Basic rate taxpayers usually have a personal savings allowance, which is simply an amount of savings interest that can be received tax-free each year. Some people with very low other income may also benefit from a starting rate for savings, which is another layer of possible protection, but the protection depends on your overall income, and that is where people get tripped up. A pension increase, a part-time wage, or another income stream can narrow the space more quickly than expected. The note to write down for this one is this: interest counts now. Do not assume your bank interest is too small to matter just because it used to be. Check your annual interest across banks, building societies, and national savings accounts because the total is what matters. And if you find these small reminders useful, you are very welcome to subscribe and keep the habit going with me. This matters especially for careful savers, the very people who tend not to think of themselves as having tax problems. You did the sensible thing, kept money aside, spread it across accounts, and avoided silly risks. Then rates rose, the interest improved, and without any dramatic lifestyle change at all, the tax rules started leaning closer. That is why quiet tax mistakes often happen to the prudent, not only to the careless. The fifth thing is less talked about, but it can make a meaningful difference in an ordinary household. A lot of couples do not check whether they are missing simple household allowances or simple ownership choices that affect tax. One spouse may have unused allowance while the other pays basic rate tax. Or savings and investments may all sit in one name simply because that is how things have always been. The best-known example is marriage allowance, where a lower-income spouse can in some cases transfer part of their personal allowance to a basic rate taxpayer spouse. It is not for everybody, and the rules do matter, but plenty of eligible couples never claim it. There are also cases where it makes sense to review whose name savings are held in, depending on income levels and the tax position. The plain English phrase here is use the household, not just the individual. People often feel awkward about this point because it sounds like financial engineering and they do not want that. But this is not about fancy schemes or trying to outsmart the law. It is simply about making sure a married or civil partner household is not sleepwalking past reliefs the rules already allow. And if you appreciate having somebody spell that out without the jargon, you know where the subscribe button is. Linda is 66 and Tom is 70, and they have always kept things simple. Most of the savings were put in Tom's name years ago because he handled the paperwork and nobody revisited it. Linda's income stayed low enough that part of her allowance was effectively going spare, while Tom kept paying tax on income that could have been arranged more sensibly. Nothing dramatic, just another quiet leak, month after month, from a decent, careful couple. The sixth thing to watch before April is the pile of paperwork people avoid because it feels annoying rather than urgent. I mean, the P6O, the coding notice, the pension statement, the interest summary, the message about a refund, the letter that looks official but feels confusing. These bits of paper and email are usually the first whisper that something is off. Ignore enough whispers, and by summer, they turn into a headache. You do not need to become an expert in tax forms, but you do need to know what deserves a second look. A P60 is the year-end summary from a pension or employer showing pay and tax taken, and it is one of the simplest ways to spot whether things feel wrong. AP 800 is a tax calculation telling you HMRC thinks you have paid too much or too little. And scam messages often pretend to be tax refunds, which is why panic and haste are such expensive companions. So the phrase for this final point is very simple. Pause, check, ring back. Do not click refund links in texts or emails. If something looks urgent, step away, use an official number from a genuine letter or the government website and verify it properly. And if you want more of these calm little guardrails around later life money, subscribe and let this channel keep you company. When you strip all this back, the 3 quiet tax mistakes before April are these: wrong code, wrong timing, and wrong assumptions. Wrong code means the deductions are off, wrong timing means a withdrawal or extra income lands badly, and wrong assumptions mean you think each small stream lives on its own. Everything else we have covered today is really about catching those 3 before they drain more than they should. So let me give you a very practical little March ritual, because knowing the risk is only half the job. Make a cup of tea, sit down somewhere quiet and gather your pension payslips, your latest coding notice, your bank interest figures, and any note of extra income. Then ask 4 plain questions. What came in? What tax was taken? What changed this year? And what still needs checking before April 5th? If you want, write those 4 questions on a scrap of paper and keep them near the kitchen drawer where the paperwork usually lands. That tiny habit is often enough to stop the whole year blurring into one pile of unopened envelopes and vague assumptions. And if that sort of no-fuss routine helps you feel steadier, do subscribe, because steady is what we are aiming for here. Not clever, not flashy, just steady. Then look at whether one pension has suddenly become the place where all the tax is being collected. Look at whether a one-off withdrawal has been hit harder than expected. Look at whether interest has grown quietly in the background. And if you are part of a couple, look at the household picture as well as your own. None of this is about obsessing over every penny or living in fear of HMRC. It is about refusing to let ordinary decent people lose money through silence, timing, and confusion. That matters more in later life because the margin for waste often narrows, while the need for calm becomes more precious. Money is not everything, but peace of mind is hard to buy back once worry sets in. And if there is one person in your life who would genuinely benefit from this, do send it to them quietly. A parent, a neighbor, a friend from work, a brother, a sister, somebody who always says they will sort the paperwork later. Not as a lecture, just as a kindness. Sometimes sharing one clear explanation is the kindest financial help you can offer. I want to come back to the theme we started with, because it really is the heart of the matter. Tax mistakes in retirement are rarely dramatic at first. They are more like tiny losses hidden inside ordinary routines, and ordinary routines are exactly what most of us stop questioning. That is why a small check before April can protect far more than the small effort it takes. Think of your finances like an older house you know well and care about deeply. You do not wait for the ceiling to fall in before you notice the damp patch, the loose tile, or the drip in the loft. You walk round, you notice, you mend the little thing before weather, and time turn it into real damage. Your pension life deserves that same quiet respect, that same steady hand, and that same timely attention. So before April arrives, lift the lid, check the drip, and keep more of your own money where it belongs. And if tonight you do nothing else, do that one calm household round and look for the quiet leak. A settled life is built by small protections, noticed in time.